Friends, in this video for iThought Advisor, I'm going to talk to you on the topic equity fund selection. This is something that has been oversimplified and it continues to be oversimplified. On the one hand, you have this opinion that, forget about funds, just go with the NIFTY. While that approach looks very safe, is it all that safe? The NIFTY has nearly 40% weightage to one sector. It's no more a balanced representative index. So, if you're buying the NIFTY, you're actually taking a financial heavy stance on the market. This comparison of the NIFTY with the active funds tends to oversimplify and ignore the importance of having a balanced investment approach. In my view, NIFTY has an imbalance, especially in bull markets like the present. It was there in 2008, it was infra heavy. In 2000, it was tech heavy. So, NIFTY has always had this track record of becoming very imbalanced at the peak of the market or around the peak of the market. Then to actively managed funds. When you come to actively managed funds, how do people select funds or how do they form judgments? My observation is most of the judgments are formed based on past performance. The industry itself has this top quartile approach where they think that the fund that has come in the top quartile of funds in the quarter is the best fund. From a past perspective, you can't argue with that. But the past and the future need not be connected. Let me give you an example. 2 years ago, when the markets crashed, the FMCG heavy large cap funds looked like they were more robust than cyclical heavy funds or funds which had more exposure to cyclical businesses. So, they were in the top quartile. Then, post-COVID rally saw Reliance heavy and FMCG heavy funds looking the most robust. But beyond a few quarters, did these funds really remain and maintain their position as performing funds? Did the past performance sustain across several quarters? The answer is no. So, under many circumstances, the fact that a fund manager is traveling with a few companies which provide the market stability can lead to short-term outperformance. But that does not mean that the fund remains a robust long-term investment. This has happened in the large cap fund space several times. Then, the past data and the future are clearly not connected. So, somebody could have taken pain and built a portfolio which is more forward looking, right? And you tend to ignore him and go with the portfolio which is more past looking, right? This is happening all the time in our markets and more so with investors who look at past performance only while making their investment decisions. So, you may ask, what is the alternate approach? The alternate approach is to look into the portfolio, to see how the portfolio is constructed, to see the future of the portfolio after breaking it down. Look at the top 5 holdings, see how they look positioned for appreciation. Look at the top 10 holdings. Look at how 80% of the fund is distributed. Look at the level of concentration in the portfolio. Look at whether the fund manager is taking a concentrated approach or a diversified approach. Either ways, look at how he is managing risks. Look at how he is protecting you from the downside and look at how he can give you an upside. All these things call for more detailed research, more granular understanding of the fund management approach, a clear perspective of the portfolio construction and constant homework. The solution or the alternative to doing all this is looking at past performance. In my view, Past performance is like a weak adhesive that puts together an investment decision. Someday the decision will come apart. Whereas if you have a solid framework to look at a fund and look at the fund manager, look at the portfolio construction and look at risk management, then you are better placed to make an informed judgment. It's not that only retail investors make this mistake of looking at past performance. Even the people who give you the stars for funds always get caught at the top of the cycle glorifying the wrong funds. So, rarely do you see people actually supporting a fund management approach and a investment approach which is extremely robust in the tough times. In the tough times, you tend to reduce your assessment of the fund exactly when you should be improving your understanding and raising your assessment of the fund. You tend to drop it because you don't want to look silly in the eyes of others if the fund does not perform. But fund selection is about being willing to look silly for a few quarters in the eyes of others and then delivering investment performance as an advisor or as an analyst. Obviously, we don't have that luxury in our industry today. So, most people take the expedient approach of hugging past performance very tightly. The problem is future performance is actually standing far away from past performance many times in the cycle. Importantly, every investor must understand this and apply fund selection without relying solely on past performance. Try and get granular, understand what the fund manager is doing, understand the portfolio construction, understand how it will perform and deliver. Then you will be able to do much better. That will also settle this argument that passive funds are superior to active funds. Certainly not. If you have an understanding of what an active fund manager is doing and how it will deliver results for you, you are certainly going to beat the passive funds. And this is being repeated time and again, and it will continue to happen. If you like this video, do share it with your friends who are keen students of mutual fund investing and passive investing, be it active investing or passive investing. Learn to make more informed choices, equip yourself and become better investors in the product universe. Thank you for watching this video.